In progress.
Okay, welcome back to the next in our series of Introduction to Financial Services Industry. This is part 3 of equities. So let's get right into it. Again, my usual disclaimer. The first type of equity products we're going to talk about in this section are what's called rights. You will sometimes see, as you can see in this example, in the Wall Street Journal or other financial publications, not as much now, but years ago, you'd open the newspaper, you see an ad like this. And what this ad says is this is a corporation called USG, and they would publish this in the newspaper. And what they're doing is they're saying that the company is going to be offering rights. It's going to be selling rights to current stockholders. So if you're a stockholder in the symbol USG, they're telling you that current stockholders will have the ability to buy rights, to buy more of the stock. Because what's happening is the company is going to come out, and what the company is telling people, it's telling existing stockholders that they're going to put more issues for sale. The company is going to offer up more shares to the market. So let's say a company has 10 million shares, and it's got 5 million shares currently in circulation in the market. That's 5 million shares outstanding. And to raise money, the company wants to take 1 million more shares that the company holds and offer them to the market. Before they offer it to the general public, they go out to the current stockholders and say, hey, we're going to offer you the right to buy a proportional number based on how many shares you hold. We're going to let you buy more shares, and we're going to offer it to you at a price that usually is less than what the market would bear. So it's a good deal is what the company is trying to say, generally. Not always. But rights are also only for a very short period of time. Like you can see in this example, the record date is June 30th, and it expires on July 27th. So what rights are the corporation extending out to current stockholders the right to buy more shares before selling to the general public. So rights are the right to subscribe for or convert another security, such as a bond, into common stock, ordinary shares of the firm, also known as subscription rights or share purchase rights. Now, so the rights would be offered. So let's say the right might be for every 10 shares that you own today, the right says that you can buy 2 shares in the future in this new offering. And rights are only for a very short time. So why are they being offered? They offer rights so that existing stockholders can maintain their proportional ownership in the firm. So what does this mean? Well, my best explanation is go out and watch the movie Social Network, where you'll notice like halfway through the movie, Mark Zuckerberg's roommate, he thinks he owns a big piece of Facebook, and then what happens is they bring out more shares and they dilute his ownership. So the purpose of rights is rights are offered so that people have an opportunity to maintain their proportional ownership in the company and not have it get diluted, right? To prevent from happening to shareholders what happened in that scene in the movie about Facebook. Now, I would say that rights were more prevalent in the past they're less prevalent today, but they still happen, and they're more common to see in Europe than you'll see in the United States. But again, the concept of rights here, that the company, before offering more shares to the general market, is offering to existing stockholders the right to buy more shares at a what presumably a discounted price. That's what rights are. Okay. Next product we're going to talk about are warrants, right? And here's a warrant certificate for a company called Fairpoint Communication. They offer these warrants. Okay, so a share warrant or a stock warrant is an option to buy stock at a set price with a specific time, usually with a time limit of 15 years maximum. They're issued by the corporation to sweeten the pot when selling new equities and convertible bonds to make the offer more attractive. So sometimes what will happen is when a company is offering is floating a new bond issue, or they're floating a new stock issue, they'll offer warrants in addition to that as a way to sweeten the pot to make the offering more attractive. Warrants operate a lot like a derivative stock options. The only thing is, instead of it, like stock options, which are traded on the market and they're offered by individuals write calls and puts. A warrant is between the holder of the warrant and the corporation, whereas a stock option are two investors. So warrants are very similar to options conceptually, but they're with the corporation. The corporation is issuing the warrant, and the other thing is derivative options are normally for very short periods of time, 3 months or so, right? Whereas warrants can go over 15 years or so. So warrants are similar, but very different. So warrants offer the same leverage a stock option does, but instead of giving you an option to buy at a fixed price from another investor who owns a stock, the corporation itself is responsible for issuing the stock to those who exercise the warrants. That's what I said earlier. Okay, so that's a warrant. Now the next product we're going to talk about is one of my favorites, is American Depository Receipts, commonly known as ADRs. And you'll see this certificate, and I don't think Daimler-Benz is I think they were acquired by Chrysler or somebody, but here's what and obviously Bank of New York is now Bank of New York Mellon, so this is kind of an old certificate. So here's what American Depository Receipts are. American Depository Receipts are negotiable certificates issued by a U.S. bank that represent a specific number of shares in a foreign stock so that it can be traded on U.S. exchanges. So think of, let's say you've got a German corporation and you've got a German stock. Well, there could be users in the United States who want to buy that stock, but they would prefer to buy it on a U.S. exchange, so it settles at the DTC, and it settles in U.S. dollars instead of euros or some other currency, and the taxes are paid in the U.S. So for a whole lot of reasons, a U.S. investor might want to buy a European security or any foreign security, but rather than buy it on the foreign market, the user might want to buy it on the U.S. market using U.S. dollars to do the purchase and to be paid back in U.S. dollars on the sale, and to do all the settlement through DTC in the U.S. market in U.S. dollars with U.S. taxes. So it's a way that's been invented for foreign stocks to be traded in the U.S. on the U.S. exchange as if they're U.S. products. So what happens is the bank takes, and let's say the bank will take, let's say we've got a German corporation, in this case, Daimler-Benz, which I don't think exists anymore. But so you got this German corporation. What Bank of New York would do is they would acquire, let's say, 100,000 shares of that German company in Germany. And then they would take those shares and they would lock them up in their vault. And then for each share that they have locked in the vault, they would issue one share of ADR equivalent to that share that they would then have available to trade in the US market. So if you have 100 shares that Bank of New York buys of Daimler in Germany and locks it up in their vault, they would issue an equivalent certificate for 100,000 shares or certificates, 100,000 shares of that same stock to trade in the US market. ADRs are denominated in US dollar. That's the big thing. They're not tied to any foreign currency. And the underlying security is held by a US financial institution overseas. So in the case of Bank of New York, they will have an office in Germany, in our example here, and they would hold the actual certificates, the actual stock, the German stock. They'll hold it in their vault at their branch in Germany, and they'll issue the certificates to trade in the US at the US, on the US exchange. So the thing about ADRs is they help reduce administration and the duty costs that would otherwise be levied for each transaction. It's much more convenient for a US investor to buy an ADR in the US market, settle in the US market, than it is for the US investor to take their dollars, convert them to euros, buy on the German market, let's say, settle in the German market, convert the money from euros back to US dollars, pay any stamp duties or taxes in Germany and Europe, and then also pay any tax obligations in the US. That's a much more complicated transaction. So to simplify this, they've created this product where the banks take stocks in foreign countries, lock them up in their vault, and then issue a receipt in the US that's traded as the equivalent that matches that security. Okay, so this is one way to buy a foreign company. Well, you can buy a foreign company while realizing dividends and gains in US dollars. ADRs are listed on the New York Stock Exchange, the Amex and NASDAQ, as well as the OTC. So I always found them one of the most interesting securities, and often you'll see that people will arbitrage ADRs, and I think I have a separate presentation where I talk about arbitrage, what that's all about. Okay, well, that wraps up our discussion on equities, three-part discussion on equities. If you have any questions or comments or feedback, please reach out to me. And with that, thank you very much.